Well, it's great to have Alfonso Peccatiello with us for Pepperstone Talks today. Now, Alf, obviously, you're best known for expanding investors' knowledge around the plumbing of the US monetary system and breaking down fairly complex subjects. And today, I want to change tactics a little bit. I want to understand how really you've transitioned, from the institutional world to managing your own money, and how what you've taken away that to kind of shape and cultivate your edge and the processes that others can learn from today. So welcome, Alf. It's great to have you on board. Obviously, your Macro Compass subscribers know you obviously very well, but for the benefits of people who are in Singapore, people who are watching on demand, people who are watching on socials, tell us a little bit about your journey.
Well, Chris, before I do, thanks for inviting me. It's always a pleasure to have a chat with you and be here with Pepperstone. So a bit about my background. For 8 years, I've been in the portfolio management industry with ING. It's a global bank based in the Netherlands, but actually there's offices and business around the world. And I was running a portfolio for them at the beginning of my career. Went pretty well. I then became the head of investments for the German subsidiary of ING, running a book which was mostly fixed income focused. So rates, credits, but then it expanded the mandate later on into FX, equities, and a bunch of other derivatives as well, and more active strategies. I did that until the end of 2021, and then I launched my own firm called the Macro Compass.
Yeah, good stuff. You just mentioned there about running a book. Tell us about your top three experiences about running that book.
Well, I would say the first one is that if you tested the strategy on paper and you back tested it and you did all the analysis which is possible, this is quite a different thing than running it in real market experience. And that's the first thing I learned straight away, because a lot of things worked on paper but ended up not working very much in reality because of, well, the depth of markets, which is something very important always to take into account, but also emotions, because it's much easier to put a trade and a strategy actually in a model than to run it once markets are going against you, especially. That was the first one. The second one, which was basically a corollary of the first one, is to be humble and to always challenge your core views, because everybody will have a core view, right? And will base his trading strategy, whatever it is, technical, macro, long-term, short-term, around certain core views. Now, being humble in markets, for me, means being always open-minded to really challenge your core views, not just for the sake of it, but seriously do that. That's what most investors I talk to really do if they're good. And the third one is what my mentor taught me straight away: stop out. And he used to say it exactly like I'm saying right now, with no emotions in his voice, because every single trade actually is just one iteration of a process, and you will be wrong plenty of times. So stopping out without involving the emotions into the process helps achieving better risk-adjusted returns over time.
I want to touch on that idea about challenging views. Now, obviously, when you're working in a big institution like that, you have a whole plethora of people around you. You've got access to real-time flow data. I think that's really, really important as well. But you've got analysts, you've got research strategists, you've got economists, you've got other PMs with you as well. And you're all sort of sharing views, but you've got that intelligence advantage. You've got that information advantage coming through. How did that help you make informed decisions? Did that give you a real advantage being around and getting that sort of information?
Yeah, it really did. I think the determinant was flows. If you are in the midst of a large trading floor and you can get a grasp of what's going on in different markets and get an understanding of what the big guys are moving money into which asset class and why, obviously it gives you quite an advantage, right? It makes you feel and taste the market in a different way than being maybe sitting at home running your own book or running, a book not in a trading floor. Is quite a different experience. And the other one, as you mentioned, which is correct indeed, is to be able to basically challenge your views with other portfolio managers. So sitting in an investment committee or having a chat with other PMs that have a different view from yours and have different positions always keeps your mind very open, because they'll have a rationale behind their trade which can be as valid as yours, even if it goes against your core views. So being able always to relay on others and listen to the flows and see what's going on is actually quite an advantage.
Yeah, I agree. Now, obviously, you've moved. I don't want to dwell too much on the past, but obviously, you've made the transition to now from institutional to managing your own money. But what have you taken out from that world? Obviously, you run the Macro Compass. You've got a very successful podcast as well. But what have you taken from that world to help you, cultivate your edge in the new world of managing your own money? Obviously, knowing that you probably don't have the same levels of technology as you did, the same sort of information, the same sort of access to flow that you did. What have you taken from that world to help you cultivate an edge in the more sort of personal world that you're in now?
So the transition obviously was basically done because I wanted to take all the information and knowledge that I was lucky enough to develop being in institutional world for a while and try to share it with the outside world, right? It's a macro learning journey for all of us, me included. Yeah. And I just wanted to share it with all the members of the Macro Compass and actually who else is following me on social. But the edges that you have, or you try actually to develop running institutional portfolios, are by nature kind of different from the ones you will be able to develop by running your own money or strategies at home if you're a sophisticated retail investor, for example. So the first thing you realize immediately is that the access to flows, the access to information, the access to certain technologies is taken away from you, which means that you are not that deeply involved in certain markets, which also means that if you try and insist on certain strategies where you do not have that edge from an information or technological perspective, it's not going to work. But what it is going to work instead is that you are unconstrained. You have a broader mandate. And I think everybody listening to this conversation should understand that institutional mandates and institutional investors are huge, but they are very constrained both by the definition of the mandate, Chris, but also by the fact that when there is a news, let's say the new inflation data that came from the US a couple of days ago, before a large fixed income or large multi-asset shop is able to really move money around that information, it takes a while. It takes an investment committee. It takes a bunch of people sitting in a room and analyzing the data and deciding what to do, right? I'm talking about moving the large flows. And if you are a sophisticated retail investor that has developed a framework and a robust risk management strategy behind it, and you focus on your strength, you actually might have an advantage from that perspective.
So you're thinking about being unconstrained, being more agile. And I want to talk about that framework because, obviously, I think it was in December 2021, you put out your framework for the 4 quadrants, the macro outlook effectively. So I think that sort of guides your principles, gives you that clarity of where you are in the market. So why don't you sort of give us an overview about how that strategy works, how you're thinking about the world, and how you use that framework to guide the sort of asset allocation that you have?
Yeah, so my macro framework is relatively extensive, but we can cover it, I think, step by step. Let's talk about how I look at the world first. So the macro compass quadrant model indeed tends to dictate, like a compass, what is the direction we're going in, right? And it's a very simple 4-quadrant model that looks at effectively 2 main directions on the X and Y axis, which are forward-looking macro indicators. So it's a collection of what I studied and I analytically and statistically analyzed to be statistically significant forward-looking macro indicators. They're all bundled into one axis, basically. And the other axis instead takes a look at what central banks are doing at the end of the day. So what is the monetary policy stance that they're applying towards the real economy in a relative term compared to what's priced in, and what's the equilibrium monetary policy stance that the private sector can take at any point in time. So you basically move on these 2 axes, Chris. That's what you do. One axis represents real economy, real money, credit creation. The other axis represents the financial system at the end of the day. So financial, how tight financial conditions are, what kind of monetary policy regime we're in, et cetera, et cetera. And as you move across this axis, you will always end up in one quadrant, and you will be maybe deep in one quadrant or less deep in one quadrant. You'll be transitioning, you'll be very stable in one quadrant. And that kind of macro compass gives me a big picture idea of where do we sit at any point in time. Now, that doesn't mean that you can blindly use it and say we're in quadrant 4, therefore we should not own any risk asset, which could be one of the outcome of today's analysis, just merely looking at the compass itself. Because after you do this assessment, there is a bunch more components to evaluate before you get into taking a trade or taking a certain asset allocation. And the first one, and then I'm going to stop to allow you to ask some questions, is risk reward. So what people should understand is that when you take risks, you're not just taking your own view and applying it, but you are trading against what's priced in, what's consensus at that point. It's always relative to what the market is pricing in at any point in time, right? So the first thing that I do is I look at which quadrant we're in, and then I look at how assets are priced in an absolute basis within that quadrant, and how are they behaving in relative value against each other in that quadrant. So I try to grasp basically how these assets are priced, market consensus basis, and I compare them to what I think they should be priced given the quadrant we're in and how they should behave in that quadrant.
Yeah, I think that's fascinating. I'm interested in trader behavior and the psychology that you go. So for me, when I'm running a trend following or a sort of short-term momentum strategy, I like markets obviously that are trending, and I like markets that are going up and the rate of change around that. So I'd imagine when you're firmly in one quadrant, you would see the behavior, the aggregation of flow all act as one, and that your sort of the propensity for trending conditions would obviously increase. I'm taking an assumption that that's correct. But, when you're transitioning as well from one quadrant to another, and the market's trying to make up his mind, what is the sort of trading behavior? What are the market dynamics? Would you see much more sort of scatty price action, much more sort of choppy price action going as we transition, and then we actually see trending conditions when we firmly get into one quadrant? How have you observed that?
Yeah, so basically, Chris, you are very neatly summarizing the two types of macro trades or macro regimes that actually tend to be there. There is a macro trending kind of trade, and then there is a relative value or a mean reversion kind of trade, right? And those are two very different trades, which also demand different sizing and different risk management around. And a macro trending trade would, or in a certain asset class, would generally tend to happen where you're transitioning between quadrants, and especially if the market isn't appreciating that the transition is going on. So that would be typically, for instance, in November, December 2021, when my models were saying that we were transitioning towards quadrant 4 pretty quickly. Quadrant 4 is the most risk adverse quadrant of all, let's say. But the market was firmly still believing that we were growing very fast and the central bank would remain accommodative, et cetera, et cetera. So was placing ourselves in a different quadrant. And when you have that transition that happens fast according to your models, but it's not captured and appreciated by markets, you end up in macro trending, in momentum macro strategies. Yeah. And those need to be handled in a certain way. And we can get into that differently to today, where we sit in a quadrant 4. And I think it's more widely recognized by markets as well that risk appetite is not there. Central banks are tightening. They'll remain tight. It's becoming more consensus, but still you sit in that quadrant where it's, you have seen over the last few months that it's mostly about ranges. So equities have traded between S&P, between 3,900 and 4,200, basically in and out. So it's a different environment where you can be more tactical. You can look at more mean reversion trade, relative value trades, et cetera, et cetera.
But it also, I guess, one of the things I find with a lot of retail traders who are using fundamentals is they kind of tend to look at the wrong thing, and they don't realize what is exactly priced in, because they're not looking at rates markets or swaps markets, for example, to the tune they will. But for you, this gives you sort of clarity of thought. It helps you look at the signal relative to the noise, and it helps you sort of hone in on really what matters within that regime. So it just really gives you that clarity of thought.
Yeah. So for instance, I work a lot with probability distributions and what's priced in. I'm really obsessed about that because every time we put a trade in, Chris, we are trading against what's priced in.
That's right.
We are taking a position that must differ from market implied consensus. We might have reasons why, but first of all, we got to understand exactly what's priced in. And people tend to obsess about one data point. They would look at 10-year treasuries and they would say, hey, Alf, it's 3.5%. That's all I know. But in reality, that 3.5% is basically one aggregate number that reflects the probability distributions that investors are assigning, right? They have a base case.
That's right.
Then there's a left tail, then there's a right tail. Yeah. So what is the probability attached to the right tail? What is the probability attached to the left tail? Is there a smart way I can structure the trade based on this probability distribution where I would differ in my view compared to markets? So all of that prep work, basically, before putting up a trade, I think it's generally very much rushed as a process even from sophisticated retail investors, but also from institutional investors I've seen, because it tends to be pretty laborious as kind of work, but it is very important to understand what are you trading against exactly.
I think that's a great way to look at it. We don't know the future, but we can think about things in the distribution of outcomes and assign probabilities to that. I want to talk about position sizing because, you wrote an article on this in August 2021, 5 Rules Not to Suck at Trading, or Suck in the Game, I think was the title there. Yeah. And I think your number 4 point was position sizing. For me, position sizing is key to keeping you in the game, and being dynamic to the volatility in the market, how much risk you're taking on will dictate the position sizing as well. But I think the way that you think about it within the quadrant is effectively how much conviction you assign to the trade, and that will determine your position size as well as the volatility. So talk to us about how you quantify conviction and how that sort of plays into position sizing.
So basically, my very systematic way of position sizing, it's not really related to conviction, and I can explain. Okay. I ran a back test on my own conviction sizing, and I'll let you know how it worked. Not very well. So I tend to be very systematic about that. And what I do is effectively I size each position against the underlying volatility of the asset class. And what that means is that's a blend of historical volatility, right, past and more recent, because as you said, the regime we're in is very important, right? But it's also a past volatility regime and implied vol. Okay. So the formula is 60% historical vol split between long-term, generally 5 to 10 year rolling vol, and short-term, so the last 3 months, generally speaking. And then the other 40% will be implied vol. So I look at the past, the very, very past, and then the more recent past, and then the future, or at least the implied vol, that is priced for the future, to determine what is the blended vol measure I should use to standardize the size of my position. Okay. And that is a very simple, systematic thing to program in a very, very basic Excel sheet, even if you want. But it is paramount important not to trade very light or to trade too heavy compared to the realized and underlying vol of the asset class you're trading. A Bitcoin trade can be the same size of a euro dollar FX trade. Yeah. It's as simple as that, really. But one is a 70 vol asset, the other one is a 10 vol asset. It just can't be the same size. I'm guessing you're a position trader rather than a day trader, maybe even a swing trader. But you're certainly sounding like you're a long-term holder of positions, so you'd be position trading. So in terms of looking at the implied vol in the market, what are you looking at? 1 month implied vol across the different asset classes, or what sort of duration are you looking at in terms of implied vol? Yeah, so I run basically 2 books, and all the strategies I'm talking about, or most of them, relate to what I call the macro tactical book, which is a long, short, unconstrained book, which has a time horizon of anything between 1 and 3 months. That's the ex ante time horizon for each trade. But we'll talk about running your profit. Some of my trades actually run as long as 1 year or more, because if they're running the right way, I don't see any reason why I should cut it. And we can talk about how systematically I try to do that too. Yep. So the time window is important as well, because you have to be honest with yourself and backtest your own strategy and time window ahead of you. What kind of investor are you? Yep. Are you a swing trader? Are you a day trader? Are you a macro investor? And a macro investor, even a tactical one, generally should have time horizons of a couple of months at least, Chris, to let the macro narrative play into the price, right? Or are you a long-term investor? And long-term investors have different kind of risk management needs, I would say, than a tactical macro investor has.
So just to summarize, obviously for people who are new to volatility, you're looking at levels of movement away from a mean, or what's implied. So you've got a sort of a blend between the two. Obviously, the higher that is, you're saying that the greater the potential movement. Therefore, the further out you need to put your stop loss. Therefore, the wider your stop loss, potentially the lower, the smaller the position sizing. So that your position sizing is the relative size of the expected movement. So the wider the movement, the smaller position sizing. The tighter the stop, the larger the position sizing coming through. Just to summarize on that, that's right. Yeah.
That's correct. So you should think in standard deviation terms as well, Chris. Like, that's right. Let's assume you wanna take a loss every time you get a 1 standard deviation move against you within your time horizon. So say you're a macro investor, you have a 1 to 3 month time horizon for every trade you take. Let's take 2 months. Then what you do is you look at history and implied vol, and you say, okay, let me look at the rolling 2 months move over the last 10 years. Let me look at recently. Let me look at the future. Let me determine what will be a 1 standard deviation move in my time horizon for this asset class. Okay. Well, I'm going to stop out there. Let's say you back tested that is your optimal stop given your strategy, right? Let's say that. Now, by putting that stop loss there, you effectively standardize the loss of each trade given the underlying volatility of the asset. So you are never over allocating or under allocating, because you're using one standardizer, one common denominator, which is the volatility adjusted position you're taking.
Perfect. You can look at that on an individual basis. Obviously, you can look at the volatility of the performance of the returns in the whole portfolio and target a certain standard deviation on that as well. I want to talk to you about sort of the idea about covariance within the portfolio, looking at correlations within the portfolio. So obviously, this is really front and center at the moment, because you've got a positive relationship between Treasury futures and equities at the moment. Usually obviously treasuries are defensive, and that's not the case at the moment. They're sort of working as one. So how do you observe correlation in the portfolio, and obviously use that then to try and reduce the variance in the portfolio?
So this is a lesson I learned the hard way a lot of times while running institutional book for the bank. 99% of people out there will simply just run a rolling correlation analysis on whatever they're running in the book, and then use a time window for that, 5-year, 10-year, whatever it can be, right? I think there is a big flaw into that approach. It can't be as systematic. And the flaw is that whatever the time horizon you use, it will normally mostly encompass one macro regime. That's just right. One. Yeah. So the last 10 years will be one macro regime with central bank easing and the fiscal authorities doing a tiny little bit to try and prop up the economy from time to time. No cycles, no recessions allowed, no risk-offs allowed. It would be just one macro regime. So correlations would be kind of constant, basically, apart from some bumps in that regime, Chris. Using that historical time frame to look at correlations will be pretty dangerous. Okay. So what I instead tend to do is I blend that systematic approach with what I call a macro principal component analysis of the book. Now, it sounds very complicated. It's really not. Principal component analysis is a very relatively simple statistical analysis you can run on your positions, which will try to explain what is the very underlying driver of each position you're running from a macro perspective. So are you running a book which is long treasuries or short treasuries? Is it long commodities or is it short commodities? So it basically tends to dissect and decompose each position you're running and the aggregate covariance of the book into one principal component. So there's the first, the second, and the third. And by doing that and looking at a very long time history rather than just time frame that encompass one macro regime, you have a better understanding of what kind of risk are you running. What are you replicating? What's your beta in your book, aggregate book position? Not simply looking at rolling correlation within one time frame, because that can be very dangerous. And you correctly explained one example of that, which is, at the beginning of the year, I'm going to say something else. It's very interesting, I think, for the audience. With one of the clients that I cover on a one-to-one bespoke basis, it's a hedge fund, basically. At the beginning of the year, we were looking at the fact that we thought this macro regime was about to change. So that we were entering a macro regime in which treasuries couldn't hedge equity drawdowns, because the very fact that equity drawdowns were there was because Powell was very keen on fighting inflation. Sure. So that negative correlation couldn't work. So we went and we asked basically some investment banks to price us for a digital option that was conditional on both things happening: treasury rates going up, equities going down. So we effectively asked them to quote us for that correlation breaking effectively. And basically we ended up paying very little because the market maker was pricing us based on the last 10 years of history. And that correlation effectively never broke. So that's the risk you run when you just simply look at history. You are at risk of looking at correlation within one macro regime, and that's a very dangerous game to play.
Yeah, good. Great explanation. I want to talk about, you've talked about position and sizing. So that is absolutely, it's going to keep you in the game. If you get your position sizing correct, that's what we should all be looking to achieve. But obviously, one of the things we know is that we're often wrong as traders and investors, and therefore we use stop losses to sort of get us out, and that obviously prices our risk and allocates risk per trade. But how do you use stops? You've talked about your position sizing, you've talked about your macro compass regime situation, but when you're putting a stop loss on the trade, is that systematic? Are you using trailing stop losses? Are you using systematic indicators to get you out, or are you using more of a discretionary approach to those stop losses?
So once I enter a position, Chris, what I've learned in my career investing is that the emotional effort that is involved into discretionary managing your exits and your entries and your upsizing or downsizing, it's too much. Yeah. It keeps you off and not focused on what's happening in markets really, and if there are new opportunities you can try and deploy and use to your favor, because your emotional effort in managing discretionary speaking, this exit strategies is way too much. So what I did is I developed a fully systematic approach, which means once I enter a basket of trades that I consider being a portfolio, there is a set of rules that basically takes me completely off any emotional driven decision making. And how that works is the following. There is one set of stop losses per each trade. So the stop loss is designed, given a backtest in the past, that is designed to be optimal, as in when I'm stopped out, I'm proven to be wrong, like macro wrong. I'm literally, my thesis is not playing out. Once that stop is hit, Chris, it's hit. I'm out. There is no reason whatsoever in the world why I would not respect that stop. It's actually fully systematized as well.
Perfect.
And that's a very orthodox approach, I have to say, but it serves me very well.
Yeah.
What happens is that instead, so the case when you're stopped out, well, you're stopped out bad luck. The second case, which investors are not paying much attention to, I guess, is when your trade isn't working, but it doesn't get stopped out either. It just sits there in a trading range and it's not going anywhere. Now, that's the second type of stop I use, and it's a time-based stop.
Okay.
So I look at the time horizon I have, and I generally multiply it by 1.5, roughly like that. I always backtest that. And if the narrative hasn't played, the macro narrative hasn't played in a longer time frame than I expected, and it's continued to suck risk away from my risk allocation, especially if it's a flat carry or a negative carry trade, you should get out because you're bleeding carry, you're bleeding risk budget, and you're achieving nothing out of that trade. So that's the second case. Yep. Time-based stop also works. And then there is the case when the trade is working. And that's the most interesting one, because I think you have some comments to make or some questions to ask about letting your profits run, which is a very complicated thing to do as well.
I think that's the issue. Is for me, I was told a long time ago that you're a manager of losing trades and winning trades take care of themselves. I completely disagree with that argument. I mean, we should deal with losing trades as quickly as we can. And in your case, you've got a back-tested, systematized situation. But I find that letting winning trades run is the hardest part, unless you're running a purely systematic situation. The emotion of having to be right is what causes people to take profits way too early in most cases. And obviously we can look back with hindsight. But actually letting a trade run, I mean, we look at the yen crosses this year, they've gone up and up and up, and everyone's been taking profits too early. And if they'd run a systematic strategy, just a basic moving average strategy crossover would have kept you in the game. So what are you doing in terms of allowing, cutting those profits, those losses early, which you talked about, but actually allowing it to run and extracting the most out of the trades?
A very basic trailing strategy, trailing stop loss, trailing profit target strategy. So once you hit your first profit target, you move your stop in a trailing fashion up, and you move your profit target higher. And if you hit your second profit target, you move it higher again, you move your trailing stop higher, et cetera, et cetera. It's a very simple way to keep you running profits unless there is a sharp move against you, a retracement that might actually be a macro change. Yeah. So it's all about backtesting and designing how to move and what is exactly the trailing motion you need to go upstairs with. But you can backtest that, and it's really, again, not very complicated. But most importantly, let's not miss the forest for the trees. The emotional discretionary component of having to decide at every point in time whether the trade has run too much or too little, or it's time to take profits, or, oh my God, I made 5% of in one trade. I need to take it 5% of my entire budget in one trade. I need to take profits because it could go against me. And then finding out that it would have made 20% a month later, that emotional toll, it's just almost unbearable, if you ask me. And it's much easier to systematize that. And by systematizing this, I'm going to make one example. In January this year, I entered a flattener on the US curve trade. So I sold 2-year bonds and I bought 10-year bonds in a duration adjusted manner via futures. Now, when I did that, the curve in the US was a 75 basis point positive slope between 2-year and 10-year. And when I entered the trade, I honestly thought the flatter it could ever go in my time horizon was maybe 40, 50 basis points. It was a 2 sigma trade, standard deviation trade, by the way. It's at minus 30 basis points as we speak. Minus 30 basis point increase. That's 6 standard deviation, which is just, if you plot it on a normal distribution, it will be a 0.000% kind of event, but it ended up playing out that way, even if you adjust it by time. And I was able to actually catch 5 standard deviation in that trade, not because I had a crystal ball, but because there is a systematized trailing strategy behind that just allowed me to run profits. And I think that is by far the most important thing, because that single trade is responsible, probably will be responsible at year end for a very positive year, even if I now get stopped out 5 times in a row.
So you need a couple of big ones, don't you, for the year, and the macro heads are doing all right. It's an interesting one. So you're just keeping in the game and keeping it going and extracting it the most there. Alf, I just want to quickly talk to you about when you're in a position. You've talked about having the stops, but you're actually actively managing position. Obviously, we've just seen a CPI number in the US, which came out sort of in core, 40 basis points higher than what the market was looking for. People are talking about sticky inflation. But what's most important for me is if you're going into this, this is the marquee event of the week. This is a big picture thing for the Federal Reserve. This is one of the big pictures of their jigsaw that makes up the policy decisions coming forward. And we've seen a significant move lower in equity markets, a lot of that down to flows, a lot of optionality and volatility targeting funds getting out as a result of what we've been seeing from various flow type activities and hedging activities. But when you're in a position and you're seeing this big event risk coming forward, do you take a discretionary view and saying that this could really affect my position? Maybe you're looking at implied volatility and seeing what the market's expecting from movement, and will then therefore you take a discretionary view maybe to reduce your position, or do you just say, nah, I'm going to stay in the game and let my stops do the work here?
Awesome question, Chris. And the answer again is in market implied vol and in probability distributions. So you're going to have a view. Everybody has a view. Is inflation going to print higher or lower than consensus? You're always going to have a view, right, when you run in these trades. But let's be honest with each other. Most likely you don't have an edge in predicting whether the next month-to-month inflation is going to be higher or lower. You just don't have an edge. But what you can have an edge at is looking at what the market is pricing in terms of probability distribution and implied vol for that day. So if you think too much or too little is priced in against a probability adjusted or probability weighted outcome, you can decide to keep the size up, or what I do in most cases actually reduce the size and the risk I'm taking for each position ahead of a binary event where I have no edge. So a binary event where you have no edge, it's just most likely to be a very high realized vol environment that could lead you to make non-rational decisions. So while people are very fascinated about predicting binary events, I always find them to be very, very complicated to handle because, again, of the emotional toll and because of the very high realized vol that they tend to bring with them.
Yeah, it's an interesting one. I think I can't let you go, Alf, without sort of talking about the current regime we're in right now. A lot of uncertainty. There's a lot of factors playing through. We've got reserves about to, in my opinion, about to come down as QT comes down. The asset side of the balance sheet falls. The Fed potentially may look to raise 100 basis points. We think 75 is going to be the issue, but they've got their foot on the pedal to try and dampen inflation. There's obviously other factors that are playing through in the global macro world. But you talked about being in quadrant 4, so just tell us a little bit about how you're seeing the world right here, right now, and obviously the sort of trades that you like at this point.
Yeah, so I think we are in quadrant 4 is the most adverse for any investor, especially long-term investors, long only. Wow, that's a hard time. It's like Q4 2018 on steroids, effectively. Yeah. It's what I say. So nothing works, and it's on steroids because the central banks are much more committed this time than they were in late 2018 to fight inflation, the level of spot inflation is much higher than it was. It's very simple, really. And so if you look at one axis of the compass, you have central banks which are very tight. They're committed in having real yields much higher than any estimate of neutral across the curve. So that's going to basically make sure that the private sector gets tight financial conditions, tight borrowing conditions across tenors, across spectrums, across ratings, across industries. That's going to be pretty tight for the private sector to handle. And on the other axis, forward-looking macro indicators, well, you guys are looking at the screen, right? I mean, any survey-based metric, new orders to inventory, credit impulse, anything you try to look at that has some statistical significance in predicting future growth, it doesn't look good. So that's the summary in a few sentences of where we stand. We stand in quadrant 4. The interesting thing is what's priced in by markets then, because in November, December, markets weren't priced for quadrant 4. But now if you look at analyst expectation for GDP growth in the US, or you look at other kind of consensus-based metrics, some adjustment has been there. So again, what I tend to look at is what are the asset classes that are priced to be that are more dissonant against my assessment of where we are, right? And when I look at that, I come up with basically 2 answers. The first is cyclical industries and interest rate sensitive industries are not priced the right way yet. Do not fully discount, not nearly fully discount what's going to come ahead of us. I look at the car industry. So the auto loan business in the US is something not many people are paying attention to, but the level of subprime lending that has happened over the last 2 years in the auto loan business in the US, the level of turnover, the level of leverage that sits in there actually makes the car industry, I think, pretty prone to some accidents, given the earnings slowdown I also expect, together with the real estate market. I think the real estate market, wow, it's not fully appreciating what's coming there, with mortgage rates having doubled, monthly installment rates for mortgages having risen by 60%, and salaries in real terms having dropped on top of that. It becomes just very difficult to be in these industries. I don't think those industries are fully appreciating the path ahead, right? So from an equity perspective, I don't think that indices are appreciating what's coming, and especially some cyclical interest rate sensitive industries are looking pretty bad.
So the Fed are going to raise until something breaks.
Pretty much, but it's going to take, I don't think it's going to take much longer. I'm actually pretty surprised that so far we didn't have major accidents. There has been one, which is gigantic and not enough covered, which is the Chinese real estate market. Yeah. Chris, I mean, we're talking about the single largest asset class in the world, $50 trillion of market cap, and it's being completely slaughtered. I mean, if you look at what's happening there, it's just, right now, I think the authorities in China are trying to get the private sector to borrow, and the private sector has been completely smashed. And they're like, sorry, I'm not going to get another mortgage there. I'm sorry. Yeah. So it's the largest asset class in the world, which is getting completely deleveraged in a very aggressive way. But in developed markets, there has not been a credit accident yet. There has not been a large default yet. And the more the Fed presses and tries to make financial conditions tight just because they don't have a choice, something ultimately is going to break. And the market overall is becoming more receptive to this risk-off environment. But I don't think that, especially in interest rate sensitive, very cyclical industries, a lot is gotten priced in. And the car industry and the real estate market are pretty exposed.
Yeah, I think it's an interesting one. I really thank you today, Alf, for joining us. It's been great to hear about your quadrant and how you think about the world, how you sort of allocate a sort of a risk-reward function to that, a probability distribution, how you go about sizing positions, how you think about risk, how you manage those open positions from a sort of statistical basis, from a volatility perspective, and ultimately how you see the world with a sort of a dire situation. But no, I don't. I think that my own views, for what it's worth, is that I think if you look at the distribution of outcomes, I think the markets are probably more prone to sort of testing those June lows, and the dollar continues to strengthen, and certainly the market's still showing a very strong correlation with reserves, and I think they're only going one way as well. So it's been great to have you on board as part of Pepperstone Talks, and from everyone here, thank you very much, Alf.
Thank Chris for hosting me. It's been a pleasure.
Pleasure.